Imagine convincing the world's smartest investors to hand you billions of dollars while your company literally loses $219,000 every single hour. That is exactly what happened with WeWork. And when the company inevitably cratered, thousands of regular employees lost their jobs and their life savings. Meanwhile, the founder walked away a billionaire, leaving the investors holding the bag. Let's set the stage. It is the 2010s, and Silicon Valley is desperate for the next massive tech unicorn. Enter Adam Neumann, a tall, barefoot, tequila-drinking entrepreneur with a mess of dark hair and a pitch that sounded like pure magic. Wall Street ignored every red flag on the balance sheet to bet on Neumann's charisma. They treated a commercial real estate company like a religious movement, and they paid a massive premium for the privilege. Here is what WeWork actually did. They leased floors in traditional office buildings, chopped them up with glass walls, added neon signs and kombucha on tap, and rented the desks out to freelancers. It is commercial real estate. That is it. This chart shows their heavy math. WeWork signed 15-year commercial leases, owing billions in fixed, guaranteed rent, but they sublease desks on month-to-month contracts. If a recession hits, freelancers cancel tomorrow, but WeWork still owes billions for 14 years. This means WeWork was a highly leveraged real estate gamble. It was a ticking financial time bomb, waiting for a single economic downturn to detonate and wipe out the entire operation. To keep the money flowing, Neumann stopped calling his company a landlord. Instead, he branded WeWork as a space-as-a-service platform. By borrowing the vocabulary of software companies, he bypassed traditional real estate scrutiny. We have seen this delusion before. During the late 1990s dot-com bubble, Wall Street threw hundreds of millions of dollars at companies with no revenue simply because they bought a domain name. It was an economy driven by collective hallucination. You see the exact same behavior today. Put the words neural network or large language model into a startup pitch deck, and venture capitalists will hand you a blank check, completely ignoring if you have a viable product. This psychological manipulation worked flawlessly. SoftBank, a massive global tech fund, heard the buzzwords and poured billions of dollars into the operation, inflating its valuation to an astronomical $47 billion. Tech buzzwords function as a psychological blindfold, giving institutional investors permission to ignore bad math. Eventually, charisma runs out. When a company burns cash this fast, executives are forced to invent their own accounting metrics to maintain the charade alive. Look at this financial statement. WeWork actually published a metric they called community-adjusted EBITDA. In plain English, they took their massive, crippling expenses, like rent and marketing, crossed them out entirely, and presented the leftover number as their profit. The historical precedent for this deception is the Enron scandal. Enron used magical accounting to book profits on deals that hadn't even happened yet. The entire empire was built entirely on belief, completely divorced from actual cash flow. When a corporation is allowed to invent its own financial vocabulary, it controls the market's perception of reality. They dictate the rules, and the investors just blindly play along. The grift always hits a wall. For WeWork, that wall was their S-1 filing. Preparing for an initial public offering legally forced the company to publish their actual, unedited balance sheets for the world to see. The moment investors looked at the real numbers and remembered how to ask basic questions about profitability, the $47 billion valuation completely evaporated. The IPO was pulled immediately. The company spiraled toward bankruptcy, and the thousands of regular employees who believed in the mission lost their jobs, their stock options becoming totally worthless. The entire corporate illusion shatters the exact second people prioritize simple addition and subtraction over a founder's charisma. But here is the darkest punchline of the entire saga. To get Adam Neumann to step down from the wreckage he created, SoftBank handed him a golden parachute worth hundreds of millions of dollars. This exit mirrors the logic of the 2008 financial crisis. When the biggest banks collapsed the global economy through toxic debt, the system didn't punish the CEOs. It stabilized them with billions in taxpayer capital, while millions of people lost everything. In both cases, the cost of failure is pushed down the ladder. For WeWork, it was the employees whose stock options hit zero. In 2008, it was the families facing these foreclosure signs. The architects of the disaster are insulated, while the rank and file absorb the impact of the crash. This is how modern corporate failure actually functions. It's a structure that privatizes the rewards for leadership, but socializes the actual damage across the people at the bottom. You have to protect yourself from the hype. Reject the corporate buzzwords, ignore the charismatic founders selling you a dream, and rely on the math. If you want to stay awake to how the world actually works, hit that subscribe button to join Irony Economics. Until next time, keep your eyes open.